Here's a question worth sitting with before anything else in this video. What if I told you Japan came within a few years of becoming the wealthiest economy on Earth, and almost nobody remembers how close it actually got? In the early 1980s, Japanese cars, electronics, and steel were flooding into American markets. Not a little, a flood. Prices so competitive, quality so consistent, that American manufacturers simply couldn't keep up. Detroit's own engineers studied Japanese factory floors and came home stunned. Fewer defects, faster assembly, lower costs at every single stage of production. Quality control studies from the era found Japanese assembly lines producing a fraction of the defects per vehicle compared to American plants. That gap wasn't marketing spin. It showed up directly in repair records, warranty claims, and independent consumer surveys throughout the decade. Consumer Reports and similar publications began recommending Japanese models with a consistency American manufacturers found genuinely alarming. Word of mouth did the rest, spreading a reputation for reliability that took American automakers years to even begin closing. By the mid-1980s, serious economists were writing serious books predicting Japan would overtake the United States as the world's largest economy. Not a fringe theory, a mainstream one. Best-selling books, congressional hearings, serious people, seriously worried. American business schools started teaching Japanese management techniques as required curriculum. American executives flew to Tokyo to study factory floors the way pilgrims visit a shrine. The anxiety wasn't limited to politicians. It ran through corporate boardrooms across the entire country. Then, within a decade, that entire trajectory collapsed. Not through a war, not through a natural disaster, through a single meeting, at a single hotel that most Americans have never heard of. By the end of this video, you'll understand exactly what happened in that meeting, why it worked faster than anyone expected, and why the same underlying pattern is unfolding again today, in a different country, with the world once again unsure whether it's watching strategy or something closer to a machine that simply can't stop building. 3 questions, one underlying mechanism connecting all of them. Let's start with the flood itself, back before anyone in Washington knew how to respond to it. This is the story of how Japan almost won a trade war nobody in America remembers fighting, and why the exact same playbook is running again, right now, with a different country in Japan's old seat. For most of the 1970s, if you asked an American what "made in Japan" meant, the answer wasn't flattering. Cheap, disposable, low quality, toys, novelty items, nothing you'd trust your family's safety to. That perception flipped hard within a single decade. By the early 1980s, Japanese automakers were producing cars that broke down less, cost less to run, and cost less to buy than their American competitors. Sony, Toshiba, and Panasonic were doing the same thing in consumer electronics. Japanese steel undercut American steel on price while matching it on quality. Toyota's Corolla and Honda's Civic became case studies in business schools, not for marketing. For manufacturing discipline, American executives had never seen executed at this scale before. The term just-in-time manufacturing entered the American business vocabulary during this exact period, borrowed directly from Toyota's own production system. American executives didn't just lose market share. They studied the winner's playbook, hoping to copy it before it was too late. The irony wasn't lost on anyone paying attention. American consultants were now flying to Japan to learn manufacturing techniques, at the exact same moment American politicians were flying to Washington to complain about the products those techniques were producing. Here's a number worth sitting with. By 1980, Japan's trade surplus with the United States had climbed past $10 billion a year. By 1985, it had roughly tripled. Tripled. In 5 years. Most Americans experienced this as a consumer win. Cheaper cars, better electronics. Nobody complained about lower prices at the dealership. Auto workers in Michigan and Ohio felt something entirely different. Plants closing, shifts cut. An entire regional economy watching its main industry lose ground year after year to competition arriving by container ship. Detroit alone lost tens of thousands of manufacturing jobs across this period. Entire communities built around a single auto plant watched their economic foundation erode within a few short years, with no comparable replacement industry arriving to take its place. Towns across the Midwest, built for generations around a single manufacturer, discovered how quickly a stable local economy can unravel once its central industry stops growing. Some of those towns never fully recovered, even decades later. Two completely different experiences of the exact same trade flow. That gap between the consumer win and the industrial loss is where this story actually lives. But here's the plant worth carrying through the rest of this video. If Japanese goods were this competitive, this consistently, where was that advantage actually coming from? Genuine manufacturing excellence, certainly, but also something else. Scale, government-backed credit, export strategy coordinated at a national level in ways American companies simply weren't organized to match. That distinction, efficiency versus strategy, matters enormously for what happens next. Because American industry didn't just lose a few sales. It lost entire market segments, and it didn't get them back quickly. Market share, once lost at this scale, doesn't simply return when a competitor's advantage fades. Customers form habits. Dealer networks shift. Brand reputations, once damaged, take years of consistent improvement to repair, if they ever fully recover at all. Small, fuel-efficient cars. Compact electronics. Entry-level consumer goods across dozens of categories. American manufacturers largely ceded these segments outright, retreating instead toward larger vehicles and premium products where Japanese competition, for the moment, hadn't fully arrived yet. That retreat had its own logic at the time. Larger vehicles carried higher profit margins, and American manufacturers, facing pressure on every front, chased the segments where they could still turn a reliable profit rather than fight a losing battle on price. Retreat, not competition. That's how the first phase of this story actually played out on the ground. By 1980, the political pressure in Washington had become impossible to ignore. American auto workers were losing jobs by the tens of thousands. Detroit was lobbying hard for protection. Congress was drafting bills that could have slapped Japan with steep unilateral tariffs. Union leaders testified before Congress. Auto executives flew to Washington repeatedly. The pressure wasn't abstract policy debate. It was hundreds of thousands of real jobs disappearing in real time in front of elected officials who had to answer for it. That kind of visible anger didn't stay confined to hearing rooms either. In Detroit, at the height of the tension, auto workers who'd lost their jobs paid $1 apiece for the chance to take a sledgehammer to a Toyota, with proceeds going to support laid-off workers. It wasn't organized by any government body. It was raw, local anger, channeled into a very physical protest. News crews covered the event. Photos circulated nationally. A single car, dented by hundreds of individual swings, became an unofficial symbol of an entire region's economic anxiety. That kind of visible anger doesn't emerge from abstract trade statistics. It emerges from entire communities watching their economic foundation erode in real time. Japan, watching this pressure build, made a strategic choice. Rather than risk an outright trade war, in May 1981, Japanese automakers agreed to a so-called voluntary export restraint. a self-imposed cap limiting Japanese car exports to the United States to 1.68 million vehicles a year. Call it voluntary. It wasn't, not really. The alternative on the table was considerably worse: sweeping, unilateral American tariffs that Congress seemed increasingly willing to pass. Japan chose the lesser evil and negotiated the specific terms of its own restraint rather than have terms imposed on it entirely. This is a pattern worth remembering because it recurs throughout modern trade history. A voluntary restraint negotiated under the explicit threat of something worse isn't really voluntary at all. It's a controlled retreat, dressed up in cooperative language for the sake of diplomacy. Diplomats on both sides understood this perfectly well at the time. The word voluntary did real diplomatic work, allowing both governments to save face, while everyone involved understood exactly what had actually forced the agreement into existence. The cap didn't stay fixed either. It crept upward over the following years, reaching 1.85 million vehicles by 1984, and higher still afterward as political pressure ebbed and Japanese diplomats negotiated incremental increases. Each renegotiation followed a similar rhythm. American pressure would build, Japan would offer a modest concession, and the underlying trade imbalance would continue growing regardless. The cap functioned more as a political pressure valve than an actual economic constraint. It gave American politicians something to point to, a visible symbol of action, while doing remarkably little to actually change the underlying trajectory. Symbolic policy, in other words, standing in for a solution nobody had yet found. Here's the twist almost nobody mentions. The restraint barely worked. Japanese manufacturers responded by shifting exports toward larger, more expensive, higher-margin vehicles, and by building factories directly inside the United States to sidestep the cap entirely. Toyota, Honda, and Nissan all opened American plants within the decade. The flood didn't stop. It just changed shape. Here's a number that captures just how little the cap actually restrained anything. Even as unit exports stayed capped, the total dollar value of Japanese auto exports to America kept climbing because every capped car was simply a more expensive one. Detroit got a number. Tokyo got the profits. By 1985, Japan's trade surplus with the U.S. sat near $50 billion annually. The strategic response so far, a voluntary cap Japan had mostly outmaneuvered, clearly wasn't enough. $50 billion in 1985 money was an almost unthinkable figure for a single bilateral trade relationship. It represented, by some estimates, the largest trade imbalance between two peacetime economies in modern history up to that point. Adjust that number for inflation, and the figure becomes even more striking against the size of the American economy at the time. This wasn't a rounding error in international trade statistics. It was a structural imbalance serious enough to reshape American industrial policy for a generation. Treasury officials, Federal Reserve staff, and White House economic advisors all understood that voluntary export restraints and modest tariffs had already been tried and had already failed to meaningfully close this gap. Whatever came next needed to work at an entirely different scale. If you've been following this channel for a while, you already know what's coming next. This is exactly the pattern we keep tracing here. A country builds real, undeniable advantage, and the rest of the world eventually has to decide how to respond to it. Stick around, because the response this time was genuinely unprecedented. Washington needed a bigger lever. Tariffs hadn't worked. A voluntary cap hadn't worked. What came next didn't target Japanese cars, Japanese steel, or Japanese electronics at all. It targeted something considerably more fundamental: the price of the yen itself. And in September 1985, it found exactly that lever. On September 22, 1985, finance ministers and central bank governors from the United States, Japan, West Germany, France, and the United Kingdom gathered at the Plaza Hotel in New York City, overlooking Central Park. What they agreed to that single afternoon would reshape Japan's entire economic trajectory for the next 30 years. The backdrop mattered enormously. Between 1980 and 1985, the US dollar had appreciated by roughly 46%, driven by aggressively high American interest rates set by Federal Reserve Chairman Paul Volcker to fight domestic inflation. That strong dollar had made American exports expensive and imports cheap, feeding the exact trade deficits fueling the political pressure back home. Volcker's own policy, aimed squarely at taming American inflation, had an unintended side effect, making American manufacturing considerably less competitive on price against exactly the kind of efficient foreign producers Japan had become. One domestic policy decision, aimed at one problem, quietly created the conditions for an entirely different crisis. By 1985, the dollar index, a broad measure of the dollar's value against a basket of major currencies, had climbed to levels rarely seen before or since. That strength, however useful for fighting inflation at home, was quietly strangling American exporters trying to compete abroad. The agreement, now known as the Plaza Accord, committed all 5 nations to coordinated intervention in currency markets. The specific goal: deliberately weaken the US dollar and specifically strengthen the Japanese yen to make Japanese exports more expensive and American exports cheaper. 5 governments, one afternoon, one shared decision to move a price nobody in the private market fully controlled. That kind of coordinated intervention had essentially no precedent at this scale. Central banks intervene in currency markets regularly, in smaller ways, largely unnoticed by the public. What made the Plaza Accord different was the scale of the coordination and the explicit, publicly announced intent behind it. This wasn't a quiet adjustment. It was a deliberate, publicized statement of shared purpose among the world's largest economies. The public announcement itself did much of the work. Markets, understanding that 5 major governments now wanted the dollar weaker, began selling dollars immediately, amplifying the intervention's effect well beyond what the actual currency purchases alone could have achieved. The numbers moved faster than almost anyone expected. The yen traded near 240 to the dollar in September 1985. By 1986, it had strengthened to roughly 150. By 1988, roughly 120. That's a nearly 50% appreciation. In under 3 years. 50%. Think about what that does to an export-dependent economy overnight. Every Japanese car, every television, every ton of steel sold in dollars suddenly cost foreign buyers dramatically more, without Japan changing a single thing about how it built them. Nothing changed on the factory floor. Same workers, same machines, same quality. Only the exchange rate moved, and that alone was enough to erase years of hard-won competitive advantage almost overnight. Japanese manufacturers scrambled to adjust. Some moved production abroad to sidestep the currency effect entirely. Others cut costs internally, squeezing suppliers and workers alike to preserve their export pricing. None of these responses came close to fully offsetting a currency shift this large, this fast. This period marked the beginning of a major wave of Japanese foreign direct investment. Factories built in the United States, in Southeast Asia, anywhere the yen's new strength could be sidestepped by simply manufacturing somewhere else. A defensive response to a currency shock ended up permanently reshaping where Japanese companies actually built their products. Japan's own economists have a name for what followed: the Endaka recession, literally, the high yen recession. Growth, which had been running above 5%, slowed sharply within a single year. What kind of weapon does that? No missiles, no blockade, just an exchange rate, moved by agreement rather than by market forces alone. Not tariffs, not sanctions, not a single ship blocked or a single factory bombed. One coordinated currency intervention, agreed to at one hotel, in one afternoon. Here is the turn this entire video has been building toward. Japan's flood of cheap competitive exports wasn't defeated by American industry outcompeting it directly. It was defeated by a currency intervention that made the flood too expensive to sustain. That's worth sitting with, because it's genuinely strange when you think about it. The country that seemed to be winning the trade competition on pure manufacturing terms lost the war anyway, through a mechanism that had nothing to do with quality, price, or efficiency. It had to do with exchange rates, negotiated in a single room by 5 governments. American cars didn't suddenly get better in 1986. American factories didn't suddenly become more efficient. The competitive landscape shifted entirely through a lever that bypassed the actual competition altogether. Imagine training for years to win a race on pure speed, only to have the finish line quietly moved by officials who control the track itself. That's roughly what happened here, at the scale of an entire national economy. The race hadn't ended. The rules of the race had simply changed, retroactively, for everyone still running it. That distinction matters enormously for understanding why Japan's response to Plaza felt, to many Japanese officials at the time, less like fair competition and more like an ambush. That's the lesson worth carrying forward from this entire story. You can build the best product in the world, at the best price in the world, and still lose if the game changes underneath you through a mechanism you don't control. So did Japan actually lose? Not immediately. Facing a stronger yen and a slowing economy, Japan's own government responded with aggressive stimulus. Rock-bottom interest rates, easy credit, expansionary spending. That stimulus worked, in the short term, spectacularly well. Japanese stock and real estate prices soared through the late 1980s, in what's now remembered as one of the largest asset bubbles in modern history. Banks lent freely. Companies borrowed aggressively. Ordinary households watched the value of their homes and investment portfolios climb at a pace that felt, at the time, like permanent prosperity rather than a temporary distortion. Golf club memberships, of all things, became a genuine investment vehicle during this period, some trading for well over $1 million. That's how far the speculative fever had spread beyond stocks and real estate into essentially anything scarce enough to bid up. Corporate borrowing during this period often had little to do with actual business expansion. Companies borrowed cheaply and funneled the proceeds directly into stock and land speculation, a practice with its own name in Japanese financial circles. Zytec, financial engineering divorced almost entirely from a company's actual core business. For a few years, right up until 1990, Japan genuinely looked like it might still overtake the United States economically. Tokyo real estate, at the bubble's peak, was reportedly worth more on paper than the entire state of California. The grounds of the Imperial Palace in Tokyo, according to widely cited estimates from that period, were valued higher than all the real estate in the state of California combined. Read that again. A single palace ground, worth more than an entire American state. Then, in 1989 and 1990, the Bank of Japan raised interest rates to cool the overheating bubble. It worked. The bubble didn't just cool, it collapsed. Stock prices lost more than half their value within 3 years. Real estate, the same real estate briefly worth more than entire American states, entered a decline that lasted for over a decade. The Nikkei stock index, Japan's benchmark, peaked near the very end of 1989. It would take more than 3 decades to reclaim that same level, a recovery timeline almost nobody in 1989 would have believed possible. What followed is now known simply as Japan's lost decade, though economists increasingly call it 2 lost decades or more. An entire generation of Japanese workers entered adulthood into a stagnant economy that never fully matched the promise their parents had grown up expecting. Stock prices crashed, real estate values collapsed, Japanese banks, loaded with bad loans made during the bubble years, spent the 1990s barely functioning, propping up companies that should have failed rather than admitting the scale of the losses. Economists later coined a term for this specific failure: zombie companies. Businesses kept technically alive through continued bank lending, never allowed to fail, never given the chance to genuinely recover either. An entire economy quietly stuck in place for years. Japanese banks, rather than acknowledge the scale of their bad loans, extended fresh credit to failing borrowers simply to avoid recognizing losses on their own books. That practice, repeated across the entire banking sector, slowed the eventual reckoning, but made the underlying stagnation last considerably longer than a faster, more painful correction might have. Regulators, too, were reluctant to force the issue. Acknowledging the full scale of bad loans across Japan's banking system would have meant admitting the bubble years had been a systemic policy failure, not simply an unfortunate market cycle. That admission took years longer to arrive than the problem itself did. Japan never fully recovered its 1980s growth trajectory. Not in the 1990s, not in the 2000s. Its economy today, adjusted for the predictions economists were confidently making in 1985, looks nothing like what anyone expected. Books with titles like Japan is Number One sat on bestseller lists in the mid-1980s. By the 2000s, those same books read like artifacts from an entirely different country's history. That specific title, published in 1979, had helped shape an entire decade of American anxiety about Japanese competition. Reading it today feels almost like reading science fiction about a future that quietly failed to arrive. Here's the genuinely uncomfortable question this history leaves behind. Was Japan defeated by a foreign currency intervention, or by its own government's response to that intervention? Serious economists still argue both sides. Some point directly to the Plaza Accord as the root cause, a deliberate currency weapon that broke Japan's export engine. Others argue the real damage came from Japan's own stimulus and its own central bank's late, clumsy attempt to deflate a bubble that domestic policy had inflated in the first place. One camp blames Washington, the other blames Tokyo's own central bank. Both camps agree on the sequence of events. They simply disagree about which decision actually mattered most. There's a third view worth naming too, one that splits the difference. The Plaza Accord created the initial shock, but Japan's own policy response to that shock, an overcorrection that inflated a historic bubble, did more lasting damage than the original currency move ever could have on its own. Cause and consequence tangled together so tightly that separating them cleanly, decades later, may simply not be possible. Economist Jeffrey Frankel, whose research on this exact period is widely cited, has pushed back specifically against the theory that America deliberately engineered Japan's decline through the Plaza Accord. His research points instead toward domestic Japanese decisions during the bubble years as the more decisive factor. Other economists disagree, arguing the currency shock set conditions that made a bubble almost inevitable, regardless of Japan's specific policy choices afterward. Both arguments have real evidence behind them. This video isn't going to settle that argument for you. What's not in dispute is the outcome. A country that seemed, for one genuine moment in history, on track to become the world's largest economy, spent the following 30 years explaining what went wrong instead. If you've made it this far with me, thank you. Genuinely. This is exactly the kind of story I built this channel to tell. Not the headline everyone half remembers, but the mechanism nobody explains properly. If that's what you're after, consider subscribing and joining us. We do this every single day. All right, back to it, because there's a question worth asking directly. Why does any of this matter now, 4 decades later? Because the exact same pattern is running again, right now, with a different country sitting in Japan's old seat. Solar panels, steel, electric vehicles, a flood of manufactured goods so competitively priced that Western industries can't match them, driven by some combination of genuine efficiency and coordinated state support nobody outside the country can fully audit. China's trade surplus, its manufacturing scale, its export dominance across entire industries. The parallels to 1980s Japan are close enough that trade officials in Washington and Brussels openly cite this exact history when discussing how to respond. Some of those same officials have floated the idea of a modern equivalent to the Plaza Accord, a coordinated currency move aimed squarely at China's own exchange rate. So far, that idea has stayed a policy proposal rather than an executed agreement. China's currency, unlike Japan's yen in 1985, isn't freely floating the same way, which makes replicating that exact playbook considerably harder in practice. Japan in 1985 was a close military and economic ally of the United States, deeply embedded in a shared security relationship that made coordinated pressure politically feasible. China occupies a fundamentally different position today, a major strategic rival rather than an allied partner, which changes both the available tools and the willingness on either side to cooperate the way 5 allied governments did at the Plaza Hotel. That difference alone may make history rhyme rather than repeat exactly. Tariffs, export controls, and unilateral pressure look considerably more likely as tools of choice this time around than a jointly negotiated currency agreement ever could. This video isn't going to claim history is simply repeating itself, because it isn't. Not exactly. China is a different country, at a different scale, in a different global economy, and its own government has studied Japan's outcome closely enough to try avoiding the same mistakes. Chinese economists reference Japan's lost decade explicitly and often, treating it as a case study in exactly what not to do with domestic monetary policy after a currency shock. Chinese state media and academic commentary have both, at various points, explicitly framed avoiding a Japan-style stagnation as a defining goal of the country's own economic policy. But the underlying question Japan's story raises is worth asking about any country flooding the world with cheap goods today. Is the flood a strategy or a system that simply can't stop building? And what happens to the country on the receiving end once the flood eventually ends, one way or another? Neither question has a clean answer yet. Japan's story took a full decade to reveal its ending. Whatever's unfolding today may take just as long to fully resolve. Patience, in stories like this one, is rarely rewarded quickly. The people watching Japan's boom in 1985 had no way of knowing they were witnessing the peak rather than the beginning. Whoever's watching today's version has that exact same disadvantage. Nobody standing inside a boom can reliably tell whether they're watching a beginning or an ending. That's precisely what makes economic history worth studying carefully, rather than assuming the present moment is somehow exempt from patterns that have played out before. That's not pessimism. It's simply what a careful look at the historical record actually shows, repeated across multiple countries and multiple decades, whenever a single nation's export success starts looking permanent to the people living through it. Here's what stays with me about this story, long after the exchange rates and GDP figures fade into the background. Japan didn't lose because its cars were bad, or its engineers were careless, or its companies stopped innovating. By nearly every manufacturing measure, Japan was winning. It lost because economic dominance built entirely on trade, surpluses turns out to be more fragile than it looks, vulnerable to a lever most people never think to watch: the exchange rate itself. Manufacturing excellence, it turns out, isn't the same thing as durable economic power. One can exist without the other, and history has now demonstrated that gap at least once in unmistakable detail. Power built on trade surpluses depends on someone else continuing to buy what you're selling, at a price you don't fully control. That dependency is easy to overlook while the surpluses keep growing. It becomes impossible to overlook the moment they stop. A surplus this large is, in a sense, a bet that the buyer's willingness to keep buying will never meaningfully change. Japan's story is a reminder of exactly how wrong that bet can turn out to be, and how little warning anyone gets before it does. That's a genuinely uncomfortable lesson for any country currently riding a similar wave of export-driven success. The flood that looks unstoppable today can be stopped by mechanisms that have nothing to do with the industry itself. This is the same underlying story this channel keeps tracing across entirely different subjects: geography, infrastructure, currency, and now trade itself. Each one revealing that the things that look permanent and unstoppable are, in practice, held in place by decisions someone could eventually choose to reverse. Power, in every one of these stories, turns out to be more conditional than it appears from the outside. Japan looked unstoppable in 1985. 4 decades later, that certainty reads like a cautionary tale rather than a settled fact. Every generation seems to produce its own version of an economy that looks permanently ascendant, right up until it doesn't. Japan wasn't the first. It almost certainly won't be the last. Britain looked unstoppable once too, before the 20th century rearranged the map of global power entirely. Empires and economies both seem to share this same blind spot, mistaking a particularly good decade for a permanent condition. If this is the kind of story you want more of, subscribe and share it with 5 people who'd actually sit through something like this. Leave a comment. Tell me honestly what you thought. And tell me whether you think today's version of this story ends the same way it did for Japan. Because somewhere in a finance ministry right now, someone is quietly studying exactly this history, deciding what to do next.